Hello, and in this video, I'll be explaining efficient and inefficient markets and how you can trade them. So, what's an efficient market? Now, if you look at the charts we have here, you will discover that the market will have three candles now, right? So, this could be in a sell scenario or a buy scenario. But what matters is this, that when you have three candles like this, and then you discover that the low of this candle meets with the high, the low of this first candle, right, meets with the high of the third candle. It means that the market is efficient. What this means is that there have been a sell down, like an impulsive move down, and then the market give opportunity for sellers to still come in at this point. But in an inefficient market, say a market is inefficient, you'll have three candles and you can find a gap between the first and the third candle from the impulsive move down or up, right? And then you can discover that we'll have a gap here, right? And so this gap, for the record, is called different things by different mentors or tutors or whatever. So some persons call it a fair value gap because there is a gap in between, and it's also called inefficiency. It's called imbalance, right? So what this is saying here is, or what this means, or how it affects us as traders, is that it means that there was an impulsive move down, okay, and sellers were not given an opportunity to come into this trade. So what we expect when we see an inefficiency, it means that the price is going to pull back to mitigate this low, this first candle's low, right? When that happens, the sell continues, all right? So each time we see a reversal after an expansion or an impulsive move, right, we're going to see a retracement. Each time the market is retracing, they are looking out for two things, right? One is fair value gap or inefficiency. The other is an order block. So we'll drop on the chart for a practical example. So this is Euro USD last week, and we discovered that down here at this point here, right, another block was formed. So there was an order. This is a very long candle here that moved to the upside, okay? And when this happened, you also discover that we have a fair value gap that was formed in that particular place, right? We have a fair value gap, which is, I marked it out here as FVG, right? And notice what happened. Price came down, mitigated this fair value, took it out, and also came into the order block before a continuation. What they did here is giving buyers an opportunity to join this market, right? Giving everyone a fair chance to join this market. And if you were to take a buy on this, right, you would have used this as your entry, and you'll be having a stop loss here, right? And a 3RR, let's use like a 3RR, and that would have been like a quick in and out, okay? So that's how your fair value works on your charts. So what I advise you to do is this: you try these out, on other time frames, try it out on other pairs, and let me know how it plays out, okay? So that's fair value gap for you. And most times I actually spotted that fair value from a 4-hour time frame, a higher time frame, okay? And it plays out in almost every time frame. So try it out, and I'll be waiting for your feedback on how it works out, okay? So see you in another video, and thanks.